Alright, hello guys, and glad to have you on board again. Today we've had that FOMC meeting that I was waiting for. We're going to review it. It's not necessarily what I was anticipating, but it doesn't change too much either. The reason why I'm recording this anyway is because we've reached out early May, and this is always that time of the year in which I get my usual warning and alerts telling me it's time to go back to and prepare for summer trading mode, which is, well, a kind of a general market behavior of traders and fund managers all across the globe to actually more or less tend to think about their vacations more than the actual short-term market moves. So this is generally that time of the year in which, you know, the adage like sell in May, go away. This is absolute full of shit, of course, but the reality is it's not entirely false. It's just that the market generally tends to change its rhythm around that time. So the reality is, if the market has to go from point A to point B, it will find its way into doing it, and being in the summer just won't change any of it. So to me, it's always been very clear, we're gonna go right up here, and there's not a chance we can go we can avoid that. Or, of course, there are limited chances for this to happen, so everything can happen. We could crash and all die and stuff like that, but we'll see that it makes no sense. On the opposite direction, everything points out to we're going to get there. The question is, how do we get there? Do we get there in a volatile way, like the active trading moment, in which generally is supposed to be September to May, okay? Or are we going to do it summer mode, which is generally lesser volatile type of markets, more 45-degree angle, ups and downs, peaks and troughs, but generally over time the market just goes for the value area in a slow grinding way up. I tend to believe that this is the likeliest outcome still, but I'm not really happy with what I've seen with this recent FOMC meeting, which is the reason why I'm going to cautiously pull that motion in my portfolio management throughout the summer. So I'll explain everything in here, look at some charts, and explain the things that kind of worries me a bit. Okay, so first of all, the FOMC meeting, I was expecting the markets to confirm that the terminal rate has been reached on the 22nd of March, which seemed to be like a rational choice to me. Turns out it wasn't the case. We had an additional 25 basis points, and if you follow through the latest few days, you might have seen that anyway. I kind of felt that something was going off charts for several days and weeks. The turning point to me has been the previous PCE core number, which wasn't as I thought it would. Let me just grab that number. All right, so that was basically it. The thing is that, well, I was expect this one to inch much lower than it did, and turns out we had a very, very shallow kind of drawdown, 4.7 down to 4.6. And all of the other markers, like the short-term month-over-month, quarter-over-quarter measurement here, has been flat as crazy. So in that sense, well, it was definitely off charts for me, and that's the reason why I started to worry that we will eventually get another 25 basis points. And then we've had the other regional banks going down the lines. So I was like, okay, I don't really know what the heck is going on. It's going to be a tricky FOMC. I'd rather like to just stand still and wait for the actual decision by the Fed members. Well, it turns out they've gone for a unanimous vote of 25 basis points, which is far from what I ever anticipated. I was like, yeah, maybe we'll get 25, but if we do get it, it's probably not going to be as consensual as it was back then. Well, I was entirely wrong with that. It's been an unanimous vote of a 25 basis point rate hike. But some other factors came to kind of put that thing into more shaded gray territory by, I was mentioning back then that if we ever got in a final 25 basis point rate hike, we will never get Powell saying that this is the last one. He will always jiggle around the fact and say, well, we're going to be data-driven, full of shit stuff. You know the drill. Well, that I've got nailed. So the thing is that, of course, JJ never gave us the answer. It's really more about the markets fearing that it might have been too much. Like the final 25 basis point rate hike will have negative consequences on the real economy for sure. I mean, we're going to talk about that, but we're not necessarily going to see it immediately. So that's the reason why I'm going to argue about that. Okay, so the 10-year yield, as you can see, no big fancy move yesterday, so it isn't the end of the world. But we're trading in that slowly descending shape thing, consolidating, which means the distance between the 10-year yields and the federal funds rate, which is the shorter term end of the stick, well, basically have started to widen more, which means yesterday effect is that short terms have gone higher following the federal funds rate, when on the opposite hand, the 10-year yield increased to the downside, which is not good to me. I mean, really, really not good. That means the fundamental traders, those who look at the longer term perspective, the bond market traders, aka, disagree with the monetary policy's direction. Back into the history, remember that I told you that the bond market sent a message around the November's meeting saying to the Fed, fuck it with your soft landing, it's not going to happen, all right? You're going bold and stupid. You're willing to send some political messages rather than doing some sound monetary policy. Well, you're going to have to suffer the consequences. So remember back then, I told you something is going to break. I don't know what, but something's going to break because the bond market sent the message. And I was saying back then, it's probably going to be something in the banking sector. And well, what a surprise. Of course, we've seen the regional banks going bust by early March, and now we've seen some more and more regional banks going under. Though the reason why I also brought it up is because, well, so much of the social covering of that event is full of crap. So I would like to state the obvious, just in case you were falling for some of these narratives out there. The banking sector isn't going to fall. It's not another 2008. It's not another credit bubble that's going to burst. We're far from doing this, okay? Of course, human psychology can be as dumb as creating a crisis that doesn't exist. But for now, I don't see any reasons for that to show up, okay? But all I was saying, anyway, is that the bond market was definitely saying there's going to be a consequence. The distortion in the yield curve was the sign of something that's going to happen. Though now we know the reason for this. It's basically some regional banks haven't hedged their portfolios against the huge shift in the bond sector, and basically they've been squeezed out, meaning that some other banks are offering high yield deposits, where some of the regional banks have been buying so much of cheap bonds with very cheap coupons and very low yield, though that these guys today can't compete. The best they can get is a 1% return on their yields, on their bonds. The value of these bonds have gone down dramatically, and on the other hand, competitors are offering 3.5% to 4%. So this is the reason why there is a big squeeze of those regional banks. They just can't offer competitive yields because they've been piling up too much of these cheap credit back then, cheap credit that is also not selling well today because, well, new bonds are offering 4 to 5%. So why the fuck would you buy a bond that offers less than that? So, of course, that means the bond market is left with the same old story. The Fed or the Treasury has to step in to buy these bonds because no one else wants them. So that's the reason why it's the same old story. It's a same old balance sheet expansion system, which means all of these unwanted bonds are going to be in one place in the end, the Treasury or the Fed. So it's really the way it is, all right? It's going to end up that way. So yeah, more cowbell is expected because there's no other way around. And I've said it multiple times, all of these low yield bonds will always end up in the Fed's balance sheet forever, and they will be there until they expire because no one else, no institutional financial, no other financial institution can hold these bonds in their balance sheets because these are really, really like free, baseless reward yield-free kind of coupons, basically money that just serves absolutely no economic purpose, and they will always end up in a public office. All right, so that's really the way it is. I've always made it clear, and it's going to take years before we get out of this mess. So there's no other way around but stagflation. All right, and stagflation is the best we can hope for. That means we still have economic growth. If for whatever reason we get into deflation on top, we still have inflation. But when we'll have deflation, if we ever have it, that's the most dangerous thing. All right, so that's really the way it is. Some people would like to go through deflation now, so that's going to be a shorter term kind of recession, because we generally tend to V-shape reverse out of deflation, and that would be kind of a less longer kind of situation to deal with. We all would like to get over with this, back to the good old rising days and stuff like that. And yeah, of course, the easiest solution will be going down a dramatic deflationary period. But the reality is that, well, it's really going to be very painful. And the situation of indebtedness today means that if we ever go down this path, the risk is a 1929 situation, which is, well, not something short-lived. So really, we need to be very cautious with these guys out there who say, yeah, we'd rather like to have a crisis now. Or even worse, it's an inevitable crisis. These things have to play out this way. Very, very dangerous. I'd like to say things real straight. I mean, if you were using the S&P 500, put it into the larger time frames. And there's one very simple toolkit that you can use to just flush away all of those liars. It's just take the S&P 500, divide it by USM2, okay? And you'll quickly see that, well, these guys who said the valuations are absolutely bonkers, we're at the end of whatever era it is, 2000 is just a child compared to what we've built today. The everything bubble is about to burst. Yeah, you know the drill. I mean, these guys are just making headlines and using stupid words just to catch some attention. But the reality, on the other hand, is that, well, if you just look at it, you would see that the problems we can see on some valuations, the verticality of your S&P 500 is just the denominator. So it's just basically $1 out of $2 has been created during the COVID pandemic. So of course, in that sense, the problem we have is just there's been too much money printed. But does that mean we're going to have to destroy that money? No, it just means the distortions created by that money will take years to be rippled through and dealt with. So that's the reality we're in. That's why stagflation is inevitable today, because that's the least worst solution that we could get down through now. It's really the way it is. There's no better alternative than stagflation now, because, well, what the fuck is going on? You really think we're going to destroy the COVID's money? Yeah, as you can see, some of the assets in the actual S&P 500, take the PayPals and the like, they have retraced right down to 2017 level, all right? Which means in here we've entirely destroyed the monetary base effect, all right? So it's already off. So some stocks have been pricing in the end of the world, some others didn't. I mean, if you take some things like Apple, well, do you see in here the monetary degradation? No, you don't see it. Even if you divide that one by the money supply, you would see that this is a bubble. So yes, the truth is that there are some bubbles out there, absolute staggering bubbles. But the thing is, it's not a generality. You can't just make things as a whole and say, well, everything has to go up or everything has to go down. That's the beauty of stagflation, all right? So it's always been clear to me that what we're headed next isn't a simple market environment in which everything goes up or everything goes down. You can just buy it all and get rich. It's not how it is. It's a rotation market that goes out of some things into some other things. And to me, it is the #1 danger now, to think as a whole instead of thinking in rotations. All right? Though, like we stated, these are many of the factors that you should already be familiar with. Though we've seen the 10-year yield, we've seen that for now it's consolidating, but the danger is the widening the distance between the short-term end of the stick and the longer-term end of yields, which has entirely reversed the yield curve. And what we can see is that yesterday's event has increased that distance one step further, which seems to me that this isn't a smart choice. The #1 conclusion to this is that I've always looked at it in a generalized scheme, which means I was looking at the difference between shorter term yields compared to 10-year yield, which gives me a historical oscillator of how aggressive or restrictive the monetary policy is. The higher, the more restrictive, and we're in historically restrictive territory. Though the question I'm asking myself now is, wasn't that too much? All right, because I would tend to say, graphically speaking, we're as restrictive as ever in the entire 50 years history of the debt cycle we're in. So it's very dangerous to me that the Fed has made such a political choice. It's not, to me, a sound monetary choice that's been made. It's a political stance. They said they will rise rates above 5%, so now here we are. To me, it seems like these guys were talking and having a plan, and they were just going to play that plan all along, despite external factor and external signs like the banking fragility and stuff like that. They just ignore these things and say, well, we had a plan all along, we're going to do it. That's the same old stupid policy making decisions on the politic end. So I think that what we've had yesterday is a politic decision which might have disastrous consequences. Okay, so that's all about the yields. Okay, though, as we can see, I think we're searching for the top anyway. So when we'll find it, of course, things will start to go the opposite way around soon after. So I think we're in the extreme. This was definitely the terminal rate to me. I see no graphic reasons to go any way further than that. The thing now is just how violent we're going to go lower, because this is where I think some other factors have played out through the overnight session on a dangerous manner. First of all, we're going to have a look at the WTI. If you have a look at the daily chart, you would see that overnight we've had an absolutely bearish spike, breaking below the previous low points in here. Very, very dramatic. We were already oversold, so we've gone far beyond that now. It's very, very, very dangerous to me to see those factors being played out like crazy, though we know that, of course, WTI can be heavily manipulated. We've seen the negative picture, the negative oil back then as well. So this can be due to some short-term speculative effect. It's been happening overnight, in the middle of the night, so this wasn't necessarily the most liquid part of the market, but still, these things happen. That's the sign to me that the market is reacting already to this latest rate hike, and not in the smartest manner. It generally tends to tell me that, well, I think something is off the charts. All right? To be honest, I think, well, that's the message, that probably over the summer something ugly is going to happen. I'm going to argue about that slightly later. But I think some of these things are the sign that whatever happened yesterday isn't going to be without consequences, and these consequences will likely have effects during the next 3 to 4 months. So as we're planning for the summer, and as I am planning for the summer, I do have to note that it isn't just a, yeah, okay, let's forget about it, nothing happened. No, I think something happened, and I think this something is the sign that throughout summer something ugly is going to happen, and I do believe that it's going to be related to oil problems. So we'll see all about that. Oil can have multiple implications. I wouldn't try to play the crystal ball, but just like back then on the 10-year yields, out of November, I told you something is going to happen with yields. It's going to have real world effect. I didn't really exactly knew what that would be like, but turned out to be that was the regional bank squeezed by the yield curve dramatically switching, and they've basically been left behind uncovered for these risks, which once again is the sign of their stupidity. They could have just hedged against the violent moves, but they didn't, so they got squeezed out. Though don't get me wrong, okay, the market isn't responsible for the banking collapses. Just once again, this is a cumulative factor of incompetence and very aggressive monetary policy stance, which is the Fed has done it wrong. Once again, they should have moved earlier and smoother instead of going bold and stupid because they were late. But this is, yeah, like we said, multiple factors have been acting to lead us to where we are. The choice that made by the Fed here sent another message to me that there's going to be rippling effects throughout the summer, and this will likely be oil related. All right. On the other hand, I don't think this is going to be the end of the world because I don't see the junk bonds going down. So I don't think it's going to be related to credit. I think the credit risks have been flown away or have been dealt with, and it isn't that bad. It's just we've seen regional bank going down, but it's certainly not the same old 2008 crisis. I see very limited chances of broader contagion. Otherwise, the junk bonds will be down the floors. They're not. Okay, so I think credit risks are going to stop, but the thing is that some other risks will show up. And this is, to me, the sign that the economy might slow down more than expected. So that could be some things to worry about. Okay, so there could be some things like more bankruptcies in the enterprise sectors. I don't know. So many things could be impacted, but I have duly noted this move. This move has been as well correlated with a move into gold, which has broken above the previous market resistance. It's gone into slowly but steadily trading all-time highs over the night. So this is something, once again, sending me a message. I think it's going to be retail panic at some sort. I don't know what exactly that is, but if you combine two, I would likely say this is going to be retail oriented, because as you can see, silver hasn't gone up. So that's really like the market fears have gone trading the gold and WTI into extreme levels. So I would say, I don't know what the mesh of these two will eventually end up creating, but I think this is a message for this summer. If you think we're going to have a nice and sound summer, I don't really think that's going to be the case. Something's going to hit us. I think it's a black swan type of, not a black swan, a gray swan type of event. Something that we can expect, but we don't necessarily know what exact nature it will be. So that's really the way it is. I think I can corner the area in which it may happen, but I can hardly stress what that is. All right? The message here is, well, we find the terminal rate. I guess it's definitely there. We've got multiple factors signaling the fact that it was. I can also see that this final terminal rate, this final rate hike we had yesterday wasn't necessary to me. Because if we look at the data sets, we can see that inflation is much, much lower than the core PC tends us to tell us about, that the volatile factor of food and beverages are nearing deflation actually now on a year-to-year basis. Transportation as well has been severely damaged. So all of these sectors just tend to say the opposite of what the Fed has been looking at, which is, well, the inflation is still very high, though we still need to act. And even though there has been some banking problems, the economy is sound and stuff like that. Well, the economy isn't sound, and I think there's going to be problems. And that's what the WTI and gold has said during the night. Though until then, I don't think it's going to be an end of the world type of event. Just get ready for something eventually unexpected happening in the summer. All right. Now, chart perspective, more of a short term, what do we do with it? Well, I would like to say, if I have a look at my intraday scenario context, we still can't figure out the difference between do we have another flow sequence starting by two consecutive corrective flows in here or not. I still can't defer the two. I still have that volatility alert telling me, well, I was expecting some noise around the FOMC meeting. We still have the ECB playing today, so God knows. And this actual thing will give us uncertainty for approximately 6 context blocks, which lead us right up to the next FOMC meeting in June. So I think it's still going to be a tricky area to play. My stance has always been the same. If we were on a first flow, I'm going to wait for a third range boundary. This is what we've had in here. And then I'm going to buy the Bollinger Band. So my question now is, I do have all the required signals and stuff like that to get to buy this area, but I won't. For the reasons that I have explained, I think the market will likely positively react out of this area. There are reasonable chances that we can actually break through the 4,200, but I think it's not going to be a value breakout, which means if we ever attempt to break the 4,200, I think something ugly is going to put us lower than the current support. So the reason why I share this to you is just I'm not buying in here because I know that even if we break out of this resistance, this is not going to be a safe area to put some stop losses. So if you buy this area, just be aware of putting some more distance to your stop losses so that if something ever happens, I'm going to buy that event rather than buying now. But the thing is that I'd like to also stress very simple things. I do have a bullish portfolio, which means that I'm not betting that something ugly will happen between now and somewhat likely June or July, okay? I'm just saying if it happens, that's the event that I'm going to buy. But the thing is that I'm still bullish in the meantime, and the portfolio is going to take all those gains. So my narrative in here is not, okay, don't buy. You will have better buying opportunity when the market will panic. My message is, I don't think this is a necessary event. I just know it may happen, and if it does, that's the thing I'll buy. And I'll only add up to my existing position on that event. Otherwise, either that event just never gonna happen, and my bullish portfolio will take the gains. So the matter of the event in here to me is, I don't even know if it's going to happen. I just see some market movers that tells me there is significant risks of something hitting us through the summer. I don't know the exact nature of it, but it sounds like it is going to be related to oil and gold. So I would say something related to consumption and something related to retail traders, though I don't really know what that is. Not retail traders, but related to retail panic sentiment. So fear and consumption seems like it leaves a very wide open door for things to happen. But the message is, if you guarantee yourself that something ugly is going to happen, that would be the best moment to buy. Though I'm not going to buy until then, well, that's a stupid move, because once again, who knows the future? All I know is how to handle risks. So all I can tell is that whoever buy these lows at the beginning of a second flow, and will be then applying the flow strategy, like whenever we break the previous previous resistance, I'm going to be putting my stops at break even. All I'm saying is that these stops aren't safe. If you put your stop at the break even level, these stops are very likely going to be hit. Though that's the reason why I'm not getting new positions out of those that I already have. All right. Because I don't think they're safe. That's really the way it is. All right? But I still keep the bullish exposition to my portfolio. The reason why I'm also cautious is gold and silver. Like I said, I seen gold spiking, but not silver. And that just sent a message to me. I still will do my trades, which means to me silver is definitely not a sell in here. I think it's going to go much higher. And the arbitrage of gold and silver still has a lot of room to go, but I think gold is and has a particular something particular to be dealt with. It's gone all-time highs, and the message that I have and see in here is that, yeah, I think something is going to happen with gold, not now, but during the summer. So I'm cautiously letting that guy spread out its message, and we'll see all about that. So if something goes wrong, I think people may eventually see gold as a safe haven for whatever reason there is. Okay, so that's also something that I'm going to account for when I go to my overall crypto portfolio exposition, which means I'm not taking it for granted, but if something goes wrong with gold, I have the feeling that it's not going to be Bitcoin related, because as you can see, nothing has happened. So I know the Bitcoin maxis who say, yeah, if anything goes wrong anyway, Bitcoin is always going to profit from it, and any new dollar printed is always going to end up in Bitcoin's pocket. Though I definitely agree with that. There's no way out of financial money printing. Remember what I stated earlier, all of those bonds that have been emitted during the COVID era, they will inevitably have to end up into public pockets, which means Fed balance sheets expansions, or treasuries have to hold them, or whatever. Anyway, they're going to have to figure out a way for these bonds to be put out of the market, because the market doesn't want them anymore. That's really the way it is, all right? And that can only mean money being printed one way or the other. We can change the world, we can create new acronyms, we can do whatever the fuck we want, but anyway, more money is going to be printed. So that's the way it is, though I've always seen that narrative that anyway, throughout the times, there's no other way around but crypto's going up. But that doesn't mean in the short term you can still play that stupid game of Anyway, they're going to print like crazy. Printers go brr, and that means we're going back all-time highs like that. I don't think the Bitcoin narrative has that strong short-term narrative. The next narrative for Bitcoin is the halving, and it's pretty damn far away from today. Okay, so I'm not crazy bullish Bitcoin in the short run. I definitely am over the long run, but it's going to take far longer than what you may think it is. All right. On the other hand, I'm really seeing a hell of a lot of parabolic curves, which are the signs to me of adoption and technological breakthrough. These are very rare events, so it's still the same old story to me. I see people mixing things together. I remember what the previous crypto cycles were looking like. Bitcoin goes first, and then Ethereum, and then altcoins. And boy, I don't really think that's what's ahead of us. If something is ahead of us, is something very specific, which means it's not going to be a broad market explosion of altcoins and shitcoins going through the roof. I think if there's ever a bull cycle correlated to the economic confidence model, which terminates and spikes somewhere around Q1, Q2 2024, it's going to be an economic demand. So the fuck, I don't see economic demand for Bitcoin. There are no economic use cases of Bitcoin. Bitcoin is a saving asset, so it's pretty much like trading actually the opposite way around. So I don't think Bitcoin is going to be tremendously demanded for the next few months, but it could be at a specific moment in time because we've seen gold spiking. So I think even though we haven't seen Bitcoin spiking throughout the night, I think it may profit from a potential gold explosion in all-time highs. All right. So I still think there could be a Bitcoin moment throughout the years, throughout the year to come, and potentially the summer, if something ugly hits the market, and if people see Bitcoin as a safe haven, which it is, might be a safe demand for Bitcoin throughout the summer. There's something to bear in mind. But on the other hand, all I see is that if we have economic demand, and if for whatever reason nothing happens throughout the summer, remember, a risk doesn't necessarily has to show up. It's just something that needs to be accounted for. And on that front, I would say, well, if for whatever reason things just go by and just go well, there are a few sectors in which I see parabolic demand, parabolic metrics, like the L2 adoption is still absolutely going bonkers and parabolic. So this is Ethereum demand. It's absolutely through the roof in terms of deflation that it causes on Ethereum as competition for the block space goes bonkers before we get to the next upgrade, which should solve that issue. Well, until then, it feels to me like this is 2021 over again. I mean, people are just battling for the block space, which means block producers take crazy MEV out of it. And that's always the same old demand. Now we've got the Chapella, which means more institutional adoption can show up because these guys now have reduced the risks of not being able to go out. So same old story to me. I think that some assets, in particular Ethereum and the Cosmos ecosystem, which certainly doesn't mean just buy Atom and get rich quick. But the thing is that, yeah, IBC's use cases are going parabolic as well. So the number of IBC transactions is parabolic, just like the Ethereum demand and layer 2 transactions are parabolic as well. So I think that through this economic cycle, which isn't going to be an exciting one, definitely not, there still are lots of profits to be made in the S&P 500 and in the crypto market, but certainly not going to be just buy it all. Though if you buy the S&P 500, I don't think you're going to have tremendous rewards. That's the message that I've sent multiple times in a row, and I still believe in it. I still think that the likeliest outcome for us is to have a 45-degree angle market, very choppy market, because I don't nearly believe that the volatility will instantly reduce. But this is a typical stuff. Over the summer, as the risks tend to decrease, the volatility may be reduced. I still think that this is going to be a fake market move. And I personally believe something ugly is going to hit this market very violently, okay? Though that's the reason why I think 4,200 isn't a safe support at all. And I don't even think that the support we're trading at now is going to be unviolated. I think we're going to violate that support at some point. That's a risk to account for. That means I'm not going to support this 45-degree angle on the S&P. I will support it with the portfolio, which means I'd rather like to buy some assets rather than the other way around. But I think something ugly might happen around this summer. All right, so that's the message for the S&P 500. I'd like to be on assets that will likely provide more gains than the risks, and that if the risk shows up, I'm not going to pay any attention. Okay, so some assets in which I trade on the weekly charts and so on, those that I trade until the major cycle pick. Okay, in which if there's ever some nasty event and if they're ended up getting caught in it, it's going to be short-lived and then the market will quickly recover from this. All right. Anyway, I still believe we're going at least there, possibly even all-time highs, depending on how damaging the Fed's actions will be. I definitely think the Fed's actions will create a collateral damage throughout the summer or somewhere around this summer. I don't know exactly what it will be. I just expect it to be on the consumer side of the equation. All right. We'll see all about that. So until then, I'm still kind of having the same old portfolio exposition. The only thing that has changed yesterday is that I'm not going to support the S&P 500 on this journey. I will just keep doing what I have, which means a bullish portfolio, and sometimes I'll eventually consider buying the S&P 500, but I was expecting to buy that support. I won't. Okay, so my message is, well, I'm going to take my profits whenever we go higher. I'm going to eventually reload, and I'm going to keep my exposition to the bare minimum, which is somewhere like 1 or 2 future contracts on the S&P 500, and that's going to be it. All right, so that's really the way it is. Very tiny exposition to me on the broad market bullish exposition. I'm still going to be bullish, and I'm going to get ready for a potential problem, which I will buy. Okay, if I see a problem throughout the summer, I'll be first to buy. All right, but I want to see some shock in the market, grace one, something that is expected to happen, but we don't know exactly what nature, what's going to be the nature of it, and it's going to surprise the market. So I'm going to get ready for a nasty surprise throughout the summer, and if it happens, I'll be ready to profit from it. If nothing happens, well, the portfolio is going to take the gains. Don't be among those who will say, well, Phil said something's going to happen, so I'm not going to do anything, and I'm going to wait for the panic. Well, if the panic doesn't show up, you're just going to be left behind, and it's going to be way too late for you to ever buy later. All right, so that's really the way it is. You had to take the risks before. If we cross over the 50%, that's the area, the top 50% of the range where you can't buy, you just have to let yourself play the game. All right, so that's the reason why, even though I think something ugly is going to happen, I just keep the same bullish portfolio exposition on assets that will be able to take on it without too much collateral damage. Over the short term, though, I'm not trading until then, because I still have the volatility alert, so I'm not going to increase my exposition on the S&P 500 on these areas. Even though I said I would buy the Bollinger Bands, I'm not going to do it. I still have one contract, and I think that's more than enough. So I'm going to wait for months, probably, and if something ugly happens, I'll definitely buy it. Until then, I'll let the portfolio do it, step back a bit. I still think cryptos, on the other hand, have interesting margin expositions to be done on specific assets, which currently shows some parabolic curves on their adoptions. But as long as they do, I will. If for whatever reason these parabolas gets broken, like L2 adoption suddenly pops down, and IBC transactions as well, well, I'm just going to take either the losses associated with the risk taken or just taking the profits if they're still there. But as long as it goes on, well, I'm still trading those assets. All right, so that's the way it is. It's going to be a tricky summer to me, but that's my current portfolio stance. Once and again, as a conclusion, what I'm sharing in here is what I do. Okay, I'm not an analyst. I'm not just a random YouTube guy who just spits some bullshit. I just like to say, this is my job. What I do here is trying to popularize and explain how professionals do their things. I'm not saying I'm the best, I know the future and stuff like that. All I'm just trying to teach you here is to directly and without too many filters and stuff like that, and by trying to remove as much uncertainty as possible. And subjectivity. I'm trying to show you the charts, the numbers, the things that I care of, to guide my decisions. That I try to inspire you into going into that direction rather than putting a shitload of speculations and subjective analysis on your behalf. You rather like to do the opposite way around, building a structure and trying to have consistent risk management with validations and invalidations, all right? So for now, like I stated, if you look at the charts, the WTI and gold have sent a message. I think ignoring that message would be dangerous. On the other hand, there's not, for now, a message on the actual bond market, which leads me to believe that the worst is behind us on that front. But I won't be considering it done until I see the 10-year yields building a bottom structure and retracing. Until then, if for whatever reason the bond market goes there and flushes down, just like the WTI and stuff like that, that will be the sign that another systematic problem will show up. Until then, I think we've already experienced that. All right, so as long as it doesn't get wider and wider, I think the 10-year yield is to be monitored very carefully. But the message sent throughout the night with WTI and gold seems to me that this is already the sign that something ugly is going to happen. The Fed has over-tightened. That's something that I was worried about, but now seems to be more and more real. That's the reason why I'm going to be very cautiously assessing my margin trading throughout the summer, and I'm going to keep it to the bare minimum, specifically in crypto as well, where I still have margin trades. I'm going to be very cautious on these assets that I do trade margin on. And for the rest of the portfolio, which is not margined at all, this is longer term exposition, I'm going to reassess that by September, of course. And these expositions, most of them are leading for the economic cycle, which is terminating mid-2024. So as long as we are not in those territories, there's nothing I will be worried about. All right, so the longer term end of the portfolio doesn't move at all. The short term end, yes, it does. So I'm not going to flow trade in the S&P anymore. It can go up, and it likely will, but I won't be part of it. Or if I am part of it, I'm going to quickly go take my profits. All right. So very limited position sizing on the buyings if I do some. And for now, I decided not to. And if I do some, I want to have cheaper prices to have better risk reward ratios. And if I do get to buy, I will profit take anytime the market breaks a resistance, just because it's going to be asking for lower prices and taking profits earlier than anticipated on these contexts to me all across the summer, just because of the things that I've mentioned. All right, I'm not going to go bearish. I don't think it's worth it. My only bearish hedge now is Apple, for the reasons that I mentioned as well. If there is one bubble in this market, one that has priced money printer go to infinity, and anyway, I'm too big to fail, that's really the Apple thing. So if we ever had to get out of stagflation into deflationary bust, I know one asset that will go absolutely bonkers to the cave. That's going to be Apple. All right, all of the other GAFAs as well. I mean, it's worth for Microsoft. As you can see, all of those assets are trading third range boundaries on the weekly chart. So if we're headed for a bear market, these assets will go absolutely nuts to the downside. Okay, Microsoft could lose 50% without a problem. That would be a bearish third range boundary. This means we're going to have to go lower than the October's low. That means these guys who weight absolute master weights in the S&P 500. If the S&P 500 has to go lower or stand still, I think this is going to be because of these guys. Well, on the other hand, I mean, just take some assets like the PayPals, the Lucid Motors, they were already broken down. What the heck do you think these guys are going to lose another 50%? Okay, sure, they could, but it's going to be marginal. I mean, if these guys lose 50%, you're barely even going to see it in the charts, okay? So once again, bear that one in mind. Those who have to lose the most are the headliners, the unicorns, the unbreakable, the too big to fail. If we ever go down deflation, I don't see any reasons for it to happen until the 10-year yields goes lower. But if it does, if you see the 10-year yields failing to find supports, oh boy, you're going to be worried with the big names, because they're going to fall like a rock. Okay, so that's really the way it is. Always get insured, always get safe. The market doesn't seem bearish to me at all. If it ever has to be, well, the ones that's going to lose the most are the ones that haven't suffered at all already. All right, so until then, you take that as a risk. that you have to manage, but you don't take that as a granted, because so far the 10-year yield doesn't seem to show any signs of deflation ahead. All right, it just seems to say stagflation for at least a couple of years until the yield curve stabilizes itself, and then we'll see what's next. Either we go deflation or we go back through inflationary boom. But out of stagflation, there's only two ways, either inflationary boom or deflationary bust. But currently we're here, and there's no sign to me that we're going out of this area, though stagflation seems like the best compromise at the moment. All right, but the over-tightening of the Fed is now no longer a myth. It seems to be a reality, and that means it's not gonna be a safe and sound sailing throughout the summer. I think quite the opposite way around. I expect choppy markets, and I expect some gray swan, which is kind of an unexpected event that is still expected some way, but we don't exactly know what it's going to be all about. So that's the reason why for the S&P 500, and to me the problem is US-centric only, I am not making margin trades despite short-term ins and outs with very limited expositions. That's really the way it is. For the rest of the world, nothing has changed to me. For the cryptos, same thing as well. All right? But I wanted to make that update, and I hope you guys understand the reasons for it. Bye, guys.